UK Tax Podcast, Tax Risks of Liquidation Distributions, Navigating the TAAR, with John Kavanagh.
Welcome back to the UK Tax Podcast. My name is John Kavanagh and I am a chartered tax advisor with my own private practice. I mainly advise other professional advisors, but also private and business clients. I've been working in tax for 40 years and have been a chartered tax advisor for well over 30 years, so I hope this podcast will offer something useful. In this episode, I want to talk about a particularly difficult tax issue that often arises in the context of liquidations of privately owned companies, especially but not exclusively of personal service or consultancy companies, namely the risk of distributions in the liquidation being taxed as income rather than capital under the Targeted Anti-Avoidance Rule, or TAAR. This is an issue that many advisors will be familiar with, but unfortunately the lack of clear case law or definitive guidance means that it remains an area of significant uncertainty. The core question when looking at whether the TAAR applies is whether the individual receiving a distribution in a winding up subsequently carries on a trade or activity that is the same as or similar to the one carried on by the liquidated company. If HMRC successfully argue that the TAAR applies, the distribution is taxed as income rather than capital, which means that business asset disposal relief, or BADR, would not be available. The legislation is set out in section 396B of the Income Tax, Trading and Other Income Act 2005. Condition C, in particular, is the relevant condition here. It effectively looks at whether, within 2 years of the liquidation, the individual carries on or is involved with a similar trade or activity, whether directly, through a partnership, or through a company in which they hold at least a 5% interest. The difficulty, of course, is that the legislation doesn't define what is meant by similar activity, so in practical terms we're left with HMRC's interpretation of that expression, which is set out in their company taxation manual. Unfortunately, the examples given by HMRC are of limited assistance, and in my view they raise almost as many questions as they answer. The examples do, however, suggest that what matters is not simply the nature of the end product or service, but the underlying business model and the skills employed. For instance, HMRC considers that a builder specializing in loft conversions is carrying on a similar trade to a builder specializing in extensions, even though the specific services offered are different. At the other end of the scale, HMRC accepts that a recruitment consultant moving into IT consultancy is not carrying on a similar activity, as the services provided and the underlying business are sufficiently different. That said, there's no binding case law on this point, so the correct interpretation of the legislation remains open to argument. In practice, this means that each case is fact-specific, and a judgment has to be made about whether the new business or activity is sufficiently different to avoid the TAAR. For example, where someone moves from consultancy into coaching, particularly if the coaching is more akin to personal development or life coaching rather than business advice, there may be an argument that the new activity is not sufficiently similar to fall within the scope of condition C. However, given that consultancy and coaching can both involve advising and guiding clients, it would not be surprising if HMRC took the view that they are similar for these purposes, particularly if there was any overlap between the services previously provided and those offered after the liquidation. Even if there is some doubt about condition C, there is also condition D to consider. Condition D looks at the purpose of the liquidation and whether one of the main purposes was to avoid or reduce income tax. Securing BADR is not in itself tax avoidance, but where the liquidation is followed fairly shortly afterwards by the resumption of trading, even in a slightly different form, HMRC may well argue that the purpose test is met. The combination of these conditions gives HMRC a fairly broad basis for applying the TAAR in practice. Ultimately, if the TAAR applies, the distributions are taxed at dividend rates rather than capital gains rates, so BADR simply isn't available. There's no scope for the taxpayer to elect for capital treatment or claim BAD. If the conditions are met, the distribution is automatically treated as income. That doesn't mean the taxpayer can't take a different view in their tax return if they genuinely believe the TAAR doesn't apply. It's perfectly possible to disclose the distribution as a capital gain, but advisors need to be aware that doing so is likely to trigger an inquiry from HMRC. That inquiry would inevitably lead to professional costs, and if HMRC successfully challenged the treatment, they could seek to impose penalties and interest on top of the additional tax due. Ultimately, if HMRC and the taxpayer can't agree, the matter could be taken to the first-tier tribunal. It's worth noting that the tribunal is sometimes more sympathetic to taxpayers than HMRC, but a tribunal hearing will itself be costly and time-consuming. There's also very limited scope for further appeal, as the FTT is the final arbiter on questions of fact. Any further appeal would have to be on a point of law, which in this case might be difficult to identify. The lack of case law means there's no definitive authority to rely on, so advisors need to approach these cases with caution. In my opinion, where there is any significant overlap between the old and new activities, HMRC will be inclined to argue that the TAAR applies, and taxpayers need to be aware of the risks involved in challenging that view. I'm John Kavanagh, and I'd like to thank you for listening to this episode of the UK Tax Podcast. More episodes are on the way, and I very much hope you will join me again for the next future episodes.